Okay, thanks for joining me for this short introductory webcast for F6 for ACCA Belfast. I've chosen income tax computations for you because it's a nice intro subject, and this will come in the early part of your studies. So in terms of an income tax computation, what are we trying to get out of an income tax computation? Well, more than likely there'll be two things, well, one of these two anyway, income tax payable and an income tax liability. Now, the only difference between those two things, if you think about the end of an income tax computation, is that the liability will come first. So that is the total exposure of an individual taxpayer in the UK to tax. So in other words, all their income goes into an income tax computation, whatever that is, I'll show you in a moment. And from that figure, what we will take off is basically items that are deducted at source. So for example, things like bank interest will have tax deducted at source, or indeed something like a dividend will have tax deducted at source, and indeed PAYE is tax deducted at source. So what we're looking to do really with any income tax computation at F6 level is more than likely calculate one of these two figures. Okay, in fact the liability comes before the payable amount. Okay, so in terms of three areas that I want you to think about before I screen share a question with you. The first one is that income needs to be included in the income tax computation gross. Okay, so inclusive of any tax that has been deducted. So the bank interest, we would gross it up by 100 over 80, the fraction 100 over 80, which effectively adds in the 20% deduction. Same for dividends, although it would be 10%. And indeed, PAYE is shown gross, not net. Okay, I've touched on tricks here, and what I'm talking about there is that for me, tax is all about tricks. It's about examiners playing tricks on you in relation to the scenario given, and seeing whether or not you know the tricks well enough to be able to adjust the figures for the particular trick. So, for example, you know, a standard trick of tax examiners would be to include in the question income which is exempt from tax, and he wants to see whether or not you're going to include it and tax it in the income tax computation, whereas in fact you wouldn't. Okay, so a couple of the points here, just move my webcam for you. Format and presentation. Okay, you know, within an income tax computation, or indeed within any computation within tax, we've got to get good at laying out the information in a clear manner, in a professional manner. And really, I see an income tax computation as a little bit like a picture. So really, when you look at the scenario in the question, if you've done income tax computations often enough in your studies, then really what you're doing is you're really filling in a picture with putting the information in the right place. Okay, and as I say, the more questions that you do, the better you get at doing that. Okay, so I'm just going to screen share a question from the Kaplan text with you. It's just a small income tax question, just to help you understand where income tax fit in, as it were. Yeah, so bear with me 1 second. So here we have it then. What we've got is a test your understanding question, and we're asked to calculate an individual's tax payable, yeah, for 2012-2013. That will be the relevant year for this year's exam, the December exam. So what you've got, if you look at the question there, I'm hoping you can see that okay. What you'll see is that within this test your understanding one is that Tony has employment income and he has PAYE deducted from that income. He also owns a couple of properties which he has a £3,000 income from, and then some investment income in the form of interest and dividends. So really what this question is asking you to do is take all of that information and really put it into the picture. Yeah, and then see what drops out at the end, which will, in this case, be income tax payable. So a really straightforward question. This type of question at this sort of level obviously wouldn't come up on the day at F6, but it's a good little grounding. So I'm just going to screen share the answer with you, and then just sort of scroll down a bit. I'm hoping you'll be able to see it okay. In effect, what we're saying then is that we need to prepare, you know, some sort of income tax computation that provides us with a bottom line figure. Okay, so the way that Kaplan have laid this particular question out is in a columnar format, just one column. There is another way to do it again, but that's not relevant for this little webcast. So what you've got here is, Tony's name, just a title, income tax computation, and really just the information listed on the right-hand side here. Yeah. So in effect, all we're required to do, as I've said, really is to slot the information from the question into a column. Now there's a couple of adjustments here, as you'll see, in the point that I made about bank interest and also the point that I made about dividends. They're being grossed up because they were taxed at source. Okay, so we've got 4 items, and then we've got total income. It's really as simple as that. And what we have here is what we call the personal allowance. So when we've calculated total income, we simply deduct the free pay allowance from total income to get what we call the taxable income. Okay. Now, what they've done is that they've looked at the rates, dividend, interest, and also employment income, and they basically split the rates over that income. So, for example, where we have other income as opposed to, let's say, savings and dividend, we have 31,895 taxed at 20%. Now, within income tax, you'll note that the tax rates go up over time or go up over levels of income. So the higher you go all the way up to the 50% level at 150 K's worth of taxable income. So really what we've got here then is a sort of a graded use of percentages against particular types of income. So as I said, the other income will be taxed within the basic rate band at 20%, savings income at the same rate, and dividends within the basic rate band at 10%. So what you'll see is that the total tax figure based on the total taxable income or the income tax liability is 7547. Now, as I said earlier on, what happens is that that's the total liability for the year. So now we then have to deduct the tax credits, in other words, the items that the individual has paid in advance, as it were, at source. So we have the liability first, then less anything that they've paid. And the difference between those two figures is really the income tax payable. So there's a very basic example. We're just doing a short webcast now, so I won't go into any more detail on this question, but as you can see, it's very much a picture that you're slotting information in. A few little tricks there, not too many in such a basic question, but that's essentially how income tax computations work. I'm just going to take you back to my slides now, and what you will have noted from the income tax computation that I showed you is that, in essence, the way that the computation works is that, questions can get more complicated, but the basic mechanics of the income tax computation don't change. So the question that we looked at, very, very simple, but, even if the individual had, 15 different types of income, essentially we'd be doing the same calculations. And it's important to note at F6 that, there are marks all over the place in terms of our easy marks, as it were. So, getting everything right within an income tax computation isn't actually the important thing. Certainly getting it finished in the time is important. So again, the more that you do, the more income tax computations that you do, the better you're going to get. Okay. In effect, what I'm saying is question practice is key. Okay. So listen, thanks very much for listening. I hope that was a helpful, very, very short introduction to income tax computations for you, and that it made sense. And I'd like to wish you all the best for your studies.